All right, good afternoon, everybody. This is Event Trader here. Going to be joined in a second by Brett Manning, chart trader of course. You with us?
Howdy.
How are you doing today?
Doing pretty good. How about yourself?
Doing pretty good. So we set to open up the Sentiment and Flow show and a quick glance at the markets, and we are near session highs on most of the indices and what's been a pretty strong day. And I guess we could kind of go back, Brett, and take a look at what we were talking about last week in the first Sentiment and Flow show, as that kind of has played out over the last couple of sessions here. And in that, we were talking a lot about how, while the market seemed extended at the time, there was still a lot of people sitting on the sidelines, and we were looking at a couple of data points that suggested that a potential FOMO could, fear of missing out trade, could start taking place. We discussed this on Monday, and then funnily enough, Lawrence Fink of BlackRock, of course, came out basically talking about the same sort of concept, with a lot of money sitting on the sidelines and portfolio managers sitting on the sidelines. And since our last talk, too, we've also gotten some pretty solid data, most notably out of China. Last Tuesday night in particular, there was some good industrial production and retail sales numbers. And now we're starting to get earnings, which I wouldn't even characterize them as better than feared, but actually coming in pretty good, and perhaps most notably, seeing a number of guidance raises. Today there was 4 Dow components out. Verizon, UTX, Procter & Gamble, and Coca-Cola, every single one of them raised their guidance, which is certainly playing into the market psyche here. You want to take a look back at what you think you've seen over the last week, Brett?
Yeah, no, I mean, I think you summarized it just right. I think we're in a situation where, like we talked about last week, there has been a persistent reluctance by particularly large fund managers to get overly involved in this market following the volatility that we saw into the end of last year. And as we've moved higher through this rally, we've consistently seen outflows from equity funds. We've seen a number of different indicators showing an over exaggerated hedging level in a lot of cases to maintain a kind of on guard sense that, you know, if the cycle is rolling over, if we're starting to see things like indicated by the inversion in the yield curve, if we're starting to see different signals that suggest that that the global expansion cycle is rolling over and we're heading into a global recession, people wanted to dodge the bullet of this fake rally, this bear market rally, and so they've kept a lot of ammunition on the sidelines, and there's a lot of data that shows that pretty clearly. And now, just as you said, we're starting to see those telltale signals that maybe this is not a bear market rally. We're headed near all-time highs right now in the S&P. We're well into all-time highs in the NASDAQ. We're starting to see stronger earnings than people had expected, even people who were expecting the better than feared numbers. We're starting to see improving data out of China. We're starting to see improving data out of the U.S. Generally speaking, this is that moment where you've got all these people sitting on the sidelines not wanting to be involved, and suddenly they take a look up and they realize that we're not that far away from the mid-year point, and they're trailing their benchmarks by a mile. You've got a lot of people who are in positions where they need to play catch up, and they're going to need to use some of that capital. So you see the kind of accelerated move that we see today. I think that that's basically part of that process of people trying to play catch up.
Okay. All right. Fred, just we'll keep an eye on this one. You're not necessarily cutting in and out, but a little bit of underwater there. So I'll keep an eye on you, and if need be, we'll call you back in here in a second. But we have had a number of data points come out over the last week since our last discussion, so we could break into that a little bit and start taking a look at some of the flows that we're seeing out there. Definitely, we haven't seen that move towards excessive optimism, but definitely feels like we are starting to lean in that direction a little bit. Obviously, the stock price action that we've seen kind of gives us some insight into that. You want to address the COT data first, or should we go take a look at the AAII sentiment numbers first? Hello, Brett. All right, hold on a second. I'm going to double check back here and see. It sounds like we lost Brett. All right, hold on a second. I'm going to double check back here and see. It sounds like we lost Brett. All right, hold on a second. I'm going to double check back here and see. It sounds like we lost Brett. All right, hold on a second. I'm going to double check back here and see. It sounds like we lost Brett. All right, hold on a second. I'm going to double check back here and see. It sounds like we lost Brett. All right, hold on a second. I'm going to double check back here and see. It sounds like we lost Brett. All right, hold on a second. I'm going to double check back here and see. It sounds like we lost Brett. All right, hold on a second. I'm going to double check back here and see. It sounds like we lost Brett. All right, hold on a second. I'm going to double check back here and see. It sounds like we lost Brett. All right, hold on a second. I'm going to double check back here and see. It sounds like we lost Brett. All right, hold on a second. I'm going to double check back All right, Brett, I think we got you back. You there?
Yeah, can you hear me?
Yeah, I can hear you.
Okay, yeah, I just switched over to a different network.
Okay, that
Right.
should hopefully.
I think we're on track now. So
Okay.
Did you hear what I was saying before?
I did hear what you were saying before. You were just kind of cutting out a little bit, but if you wanted to give a quick recap just to make sure.
Okay. You want me to recap?
Yeah, just to give a quick recap of what you were saying, just so everybody
Yeah,
was
so
clear,
I
just
mean,
in case.
I'm not sure what people heard, so sorry about that. I'm on a stronger network now. It should be consistent through the end. But basically, the idea being that we mentioned a number of different indicators showing a lot of people who were sitting the rally out, and the data basically coming through much better than expected. And so we're seeing people who are trailing their benchmarks by a country mile into the mid-year point, and so the need to put capital to work is becoming almost a fear-based mechanism, and that's the fear of missing out idea. And when you take it to an institutional kind of direction, it becomes, really a dramatically important force in the market, and we're seeing an acceleration in the trend. And this is kind of the blow-off that we were talking about last week, being concerned about there being more risk of a blow-off than there was risk of a sharp bearish reversal. So we're starting to see that play out. That was basically the gist of it.
Yeah, and you can kind of see that in the price action too. Those sell-offs, they don't seem to really last very long, and people are willing to jump in pretty quickly on those buy the dips, which has been a thing we've seen for some time now.
Yeah, competition.
Yeah, exactly, and certainly nobody wants to be caught holding the bag or sitting on the sidelines, as we're talking about. Now, over the course of the last week since our last discussion, Brett, we've definitely seen a little bit of a move towards I certainly don't want to call it excessive optimism, because we haven't really hit those levels, but certainly a move towards some of the higher end of the bars, that some of the sentiment data that we look at. So I was going to see, did you want to jump into that first, or do you want to maybe take a quick look at the commitment of traders, take a look at some of the asset-specific moves that we're seeing here?
So what I want to do is just kind of characterize things, to introduce where the data is now as opposed to last week. What I would say is, so there's two sides to it. One of the most important points so we're seeing two different ways to interpret the sentiment environment. One thing that I've seen a lot of press about lately is that there are certain market-derived sentiment measures that are at kind of extreme levels, that maybe some of them are even at all-time high levels, and it's easy to kind of take the position that sentiment is in a bubbling phase, or in something like when the dot-com bubble was in its last gasp period in March of 2000. Some of the sentiment that we saw then. There are ways to construct a sentiment data index right now that would suggest that that's what the market is doing, and some of those, I think, if you think about sort of a clickbait philosophy of the internet, some of those measures are becoming more and more popular. They're getting spread around everywhere, and a few would be the Risk Appetite Index from Sentiment Trader, the Nomura Sentiment Index from Nomura Securities, the Ned Davis Sentiment Index. There's a Dumb Money Sentiment Index also from Sentiment Trader. There's a number of different indexes of sentiment that have correlated reasonable ratios over time to suggest that, when they start to show extremes, it's time to watch out, and they're showing kind of all-time high, really explosive extremes right now. And I think it's really important to break that down and understand what you're seeing a little bit, because the one thing that all of those indices have in common is that they are market behavior derived indices rather than what I would call pure sentiment measures. So in other words, they're using an inference. They're taking something like spreads between high-yielding corporate debt to treasuries and looking at the action there, looking at things like where the TED spread is, looking at different measures that usually correlate with different swings in how people feel about the market. So they are in one state when people are really scared, and in a very different state when people are too complacent or too exuberant. And that usually matches up well, and right now they're showing extremes of the thing that usually correlates with when people are overly bullish. And in my experience, those can be useful indicators, but it's important that they're also matched up by what I would call pure sentiment measures. And in the pure sentiment measures, things like the retail only buy to open options ratio, the robo ratio, or the sentiment surveys like the AAII bull ratio, where you're actually getting to how people feel about the market, how afraid they are about a negative event, or where they think that the market is going to go in response to something like a survey, or something like we talked about last week with the fund manager survey, which shows people are extremely skeptical. And that doesn't match up very well, and this is the important point, that doesn't match up very well with things like the Nomura Sentiment Index, which is showing, all-time highs of exuberant complacency. And again, that those are inferences. Those are derived from how different markets are trading in relation to each other, rather than actually taking information about how people directly say that they feel about the market and how much cash they have on hand and how much hedging they're using. So while there are some indicators that are showing dramatic extremes, the indicators that I think are maybe a little bit more reliable and that kind of counter that sense, or show that maybe there's something different going on there with some of these other indicators, things like the robo ratio, lobo ratio, the VIX term structure, the sentiment survey, stuff like that. We've started to see them move toward extremes. They're getting near to kind of extreme territory, but they're not there. They're very clearly not at extreme territory. And when you really see the big blow off tops, something that we saw, a remarkable example was in late January of last year. All of these things were massively into extreme territory. And that was, following the tax reform bill and the kind of speculative frenzy that followed that. So we're seeing things move. They're creeping toward extremes. If we get another couple days like today, and we've got the S&P well into all-time highs and another batch of good news, and maybe we get a China trade deal signing or something, I think we'll be at that point where we've really gone through the evolution, because again, this is all about going through a transition from complete risk aversion to complete risk acceptance. And you don't want to start to fade this market when it hasn't made that full transition yet. And there's a lot of signs that we haven't made that full transition yet. And there are a lot of other data points, as we talked about
there
earlier.
would be signs that we've seen that transition in some parts, right? Like monetary policy and trade, I would think, would be two areas that we've seen kind of the sentiment fully baked.
You're talking about being priced in.
Yeah, exactly.
Yeah, I would totally agree that those themes are priced in. To me, you're not going to get a bump on the China trade, right? But you remove the last little bit of hedges and complacency. You push the hedges toward complacency. But so I think just getting them out of the way so that there's not that. One of the things that I think is good about setting up a fade when you see a market getting near an extreme in sentiment is you think in terms of, well, there's people in the market who are waiting for that headline. You know it's coming. You know the China trade deal is coming, and they're probably not going to sell until they see it.
Right.
It's the sort of sell the news reaction is it's going to be tough for people who have built their portfolios around the idea of the trade war ending. They're probably not going to actually start to sell their securities until after you get that headline. So as long as it's sitting out there, there's a protection.
We're on the flip side of that, I guess you would call them, I don't want to say the dumb money, but the people that are prepared to buy on those headlines.
Yeah, right.
You're going to caught your money in the bag, right?
Yes, and that's why that can be such a valuable shorting opportunity, because you get that swing. You bring in weak-handed long interest in a flurry at the same time that maybe you have stronger-handed sellers coming into the market. And that weaker-handed long interest just bursts the market up for a second. As it starts to tip back over, all those buy orders, they start to match themselves on the other side, the antimatter. The sell orders start coming in from the same people because immediately they start to find themselves out of the money on something that really, there's no new bullish catalyst sitting out there. They've already gotten their catalyst, they bought, and then they're out of the money. And it just starts to turn into a very quick shift in terms of market tone into a selling frenzy. And that's not impossible that we could see something like that evolve. But right now, the big point is, big picture view, we haven't reached serious extremes in any of the sort of pure sentiment index measures. We have, however, some very popularly bandied about extremes in some of these other indicators that I would just urge you to realize that their construction is not really sentiment. It's not really how people feel about the market. It is a second-degree inference-based sense. It is a construction. It is, we believe people must feel that way because we are seeing these certain things happen in markets.
So it's based off of, they're trying to base sentiment off a mathematical formula, basically.
Well, they're making an inference. In the past, when these situations have been the case, it has led to a contrarian shorting opportunity. Therefore, we're going to call that sentiment. And now we're seeing those at extremes. But it's not actually measuring how people feel about the market. It's just simply looking at things that have in the past correlated with extremes of how people feel about the market.
So when taking a look at that then, Brett, so if we're going through the sentiment data from AAII recently released, I guess we could try to use some of these points as reasons why you wouldn't be reading too much into those market inference tools. Number one, I guess, starting off with the Lobo, which we saw a little bit of a drop in, showing signs of optimism, but really hasn't hit an extreme.
Correct.
The Robo, that was one that we did we didn't see as much of a change in the Robo against the Lobo. What would you be taking away from those two readings then when you're looking at the sentiment readings?
So I generally, I mean, the Robo is actually closer to an extreme, even though it didn't change as much over the last week. But I generally look at the Robo as a stronger contrarian indicator. And one of the main reasons is, so this is taken from data that's actually clearinghouse data. We talked about this a bit last week, but the idea is you've got small accounts that are levering up using derivative instruments to speculate in the market. And it's buy to open, so it's not a hedge. So if they're doing lots of calls versus puts, they are actually taking a small amount of money and trying to hit a home run trade by using a derivative market because they're so positive the market's going up. And when there's a consensus of that kind of behavior, it usually leads to, you know you're at that point. You're at that kind of topping moment when you've got a lot of smaller account retail traders that are using derivatives to lever up and try to hit a home run, and when they're moving as a herd that way. The Lobo is a little trickier because you're dealing with large accounts and probably more professional traders, and so I don't necessarily take the idea that we can be absolutely certain that these are buy to open because there's a little bit more complexity in the transactions. So just the fact that the clearinghouse data suggests that a particular put is not against a standing equity position, there may be other ways that there's exposure that's been built. And so I tend to think that maybe there's a little bit more falling in there that's hedging rather than speculation.
Yeah, I was going to say, is it more to do with the idea that they're just trying to protect against their downside risk a little bit more and more content with a smaller return? It's
when they're doing puts, yeah.
Yeah.
So as we're seeing this ratio move in the direction that it is, it's moving toward more calls and less puts. I think this could be a reflection of people who have been left behind by this market who might be using more calls to try and play catch up. So larger accounts and maybe some fund managers in there who are using options to try and play some catch up, but against a kind of normal distribution of cash to exposure that's underweight right now. So it's not necessarily a speculative frenzy because they're dealing with a high cash balance and they're trying to offset that. Now maybe if it gets too extreme, it's going to lead to the same thing because it's a timing issue, and if suddenly they're at that moment where they're willing to stack massive calls into their portfolio to make up for that cash issue, it's a moment, and if lots of people are doing that same thing, that's a moment. That's a moment to kind of put a star next to as, hey, maybe right now there's a little bit too much in the way of assumptions of further upside. So I think it's still valuable as a contrarian indicator, but I think that the Robo ratio is usually more of a on-the-nose timing issue for me.
Now, another way to hedge that we have here is inverse ETF volume, which did see a tick up. Another one that's getting a little bit more towards the excessive optimism side. How closely do you keep an eye on this inverse ETF volume?
So I think it's really fantastic when you see a tremendous amount of volatility, and it's maybe less so as a topping signal. But it's still important. The complacency is there, but it's really tough to say necessarily if people aren't trading inverse ETFs that much. I don't know if we necessarily know timing around the top, but it is another factor that when that's extremely low, there's not a lot of fear, right? So it's just tough to say that one day's movement versus the next, and this is a daily. One of the good things about some of these indicators is it's updated every day because it's just inverse ETF volume is obviously always present. But we are definitely at a point where it has been relatively kind of at those points, but you can track along at its current level right now. I wouldn't see it as a danger sign. I need other danger signs because this is in a situation where it could track along at this level for quite some time if we saw a sustained uptrend. It's usually the other side. That indicator is usually terrific when you see a massive spike in inverse ETF volume. You know what that means. That suddenly these things are really, really popular, and usually when those things are really, really popular, it's time to start looking for a squeeze. So it's really difficult to use maybe as a timing instrument on a top.
Okay, and another one that was sticking out to me that it's still not in the excessive optimism area and falls along these and had a nice little 15% drop, and that was the equity hedging index, which fell to 35.2 in the AAII reading. How do you...
Sentiment trader.
Sentiment trader, correct.
Right.
How do you view the equity hedging index?
So, it's getting there. It's still not really that far away from kind of a middling territory, but this is an aggregation of different things. Hedging instruments is a big part of it, and so I think it reflects a lot of what's happening in the Lobo ratio. We're just sort of seeing instruments being used in a different way that suggests that there's less and less of a sense of a need to be doing lots of stuff to protect portfolios. And, that's part of the movement along that spectrum. It's not in an extreme. And this is a little bit of another one that's kind of like what we just talked about with the inverse Etf volume. It's not a tremendous timing instrument for tops, because you can get down to a low amount of hedging and sit there for a while before you start to see a problem. That's why I think the robo ratio is so interesting, just to come back around to it again, because when you see an explosion in calls versus puts by small accounts, where you're opening positions, you're not using those as hedges, an explosion in calls by lots of different people with small accounts says something about assumptions. If people are doing that, then they're doing other things too, that all reflect a sense of vastly overly complacent and exuberant assumptions about just almost a guarantee that things are about to go higher. And when you get to that point, you've got a real problem, and that is a timing issue for the market. And so that tends to be a good timing issue for fading. But the equity hedging index, people may take their hedges off or reduce their amount of hedging, and we can sit in that state for a while until we get a negative catalyst. So it's tough to time the top with the equity hedging index, but it is just like the inverse ETF volume, it is demonstrating that people aren't scared anymore, but they're not really, it doesn't necessarily speak to whether or not I think there's exuberance.
Okay, there were a few instruments readings that had us in excessive optimism territory. The mutual fund cash level, the advisor and investor model, the bear market probability model, the risk appetite index. Was anything from those readings sticking out to you, or anything notable that you want to be on the lookout for?
So when we summarized before, I don't see anything that's a good timing instrument that is flashing a red flag right now. But they're all the things you just named are things that kind of stack up vulnerability. So when you look at the bear market probability model, this is just basically straight machine learning kind of process of data mining over a large sample size that says, here's all the things that tend to happen when we're on the doorstep of a bear market. There is enough of those sorts of situations right now that could be kind of coming into play. It's a little bit of a lagging indicator, but it kind of says, hey, maybe there's the possibility that we could see, if we do see a shift, that it could be a sharp shift. The risk appetite index, we talked about this earlier. This is a market signal like the Nomura, like the Ned Davis, like the dumb money confidence. These are all kind of looking at a lot of different market behavior inputs to show that there's a correlation with what should be exuberance, but we're not seeing the other follow-up points that are exuberance. Mutual fund cash level, that's another point that's a little more lagging than the FMS cash, but that's another point that I would say is vulnerability, not necessarily a contrarian signal. So there's lots of things that could become issues if we start to see contrarian signals, but we don't see what I would consider to be genuine contrarian signals at this point.
Okay, now there's two instruments specifically that you wanted to address today, Brett. Let's break into those a little. The first one is the SPY Liquidity Premium, which was up 3% and now is at minus 20%, which is just basically on the threshold of excessive optimism. So why do you see the SPY Liquidity Premium as such an important tool for us to be watching, and what sort of movements are you looking for this going forward in the next couple of weeks?
Okay, so this is an interesting indicator that I don't think that a lot of people really understand or use, and I want to take this show as a process of also kind of focusing on a couple of things each week and saying, this is interesting, this is really interesting, and it's been really helpful to me in a number of instances, and there's a very clear reason why it would be helpful, and so I want to kind of spread that understanding and add it as a tool in your toolbox. And the SPY Liquidity Premium is essentially the statement that When people are really feeling uncertain or nervous about markets, they tend to not want to get involved in illiquid instruments because they can't get back out. So cash, think of cash as like a safe zone. You're okay when you're in all cash, and when markets are really volatile or really uncertain or there's a lot of scary things going on, people tend to really want to just hold tight to the mast of cash. And when they get involved and when they trade things, they want it to be things that they can get out of very easily if they need to at a moment's notice. When you're feeling really complacent, when there's no real problems, when you're not worried about big issues in the world, when you tend to get into that zone that's the later stages of an uptrend or a topping process, you tend to see people much more willing to trade freely in and out of anything, even if it's very illiquid, because they're not really thinking in terms of the need to be able to very quickly and smoothly get into cash. So what the SPY liquidity premium is, essentially it's a ratio of how much in and out transactionality is going on in the SPY ETF versus individual stocks. So when you see a panic like we saw in December, you see this move up really sharply, or certainly when we saw the VIX blow up back in early February, you'll see this move up very sharply because it essentially says all the trading is suddenly going on just in the SPY. Now you could do a QQQ liquidity premium, you could do a DIA liquidity premium. Any really big overarching super liquid ETF can serve as the basis point for this. But you're basically looking at the relationship between just transaction volume in something like SPY versus transaction volume in any randomly selected basket of stocks. So Sentiment Trader is the place where I get this. You probably get it other places, or you could probably just kind of watch the relationship between how much trading is going on in SPY versus going on in individual stocks and get a sense as to how people feel about the market. Because when you've got complacency, you're going to see not nearly as big of a ratio. SPY is going to have more volume than most things, but that ratio is going to be a lot less when people are feeling more confident and complacent. And when people are feeling truly fearful, then you're going to see pretty much all the transaction volume going on in these big super liquid instruments because they offer a guarantee of being able to get back out and back into cash at a moment's notice no matter what happens. And when people are concerned that some big boogeyman is going to jump around the corner, they need to feel the comfort of having that liquidity of easily exiting. So that's the SPY liquidity premium.
Okay, the other one that you wanted to take a look at, and then we're going to circle around and put all this together for everybody here. The first couple episodes for this, if it sounds a little bit more educational, that's just because we're trying to introduce everybody to the terms that we're going to be using, which is really going to be key to understanding rather than just throwing out if we're talking about the SPY liquidity premium without any sort of reference. So that's kind of why we're doing it this way at the moment. So, but the other piece that you were looking at, Brett, was the hedge fund exposure inference. This is another one. This one is not nearly in the other range of the excessive optimism that we're starting to see. You want to explain this one and why, yeah, very importantly, and why this is so important? Because I think it also helps kind of with the argument about we might see some sensationalized market sentiment numbers thrown out there, but it's key to also keep in mind where some of this, where some of the flows going, and that's where this helps out.
Exactly right. So if you look at something like, so the hedge fund exposure index basically is an inference model, and it's driven by saying, well, let's look at the main hedge fund benchmark, right? The HFRX or any of the tracking indexes that are really kind of driving toward helping hedge fund managers understand how well they're doing relative to their peers. There's a lot of tracking indexes. HFRX is a good example. If hedge funds are generally really highly exposed to the S&P, you will see a correlation between their benchmarks and the SPX index be really high. Right, their benchmark will be moving right about with the SPX when all the hedge funds have really piled into stocks. We saw that, for instance, at the end of 2017 after the tax fund bill. That was very present. You had a really, really high correlation in November and December of 2017. Right now, you have an extremely low correlation, in fact, slightly negative. So that gives you a sense of where their exposure is. If they're in stocks, they're maybe net short. And still, you know, kind of all the way up, reluctant about getting super involved. And my theory is Because at the same time, we've also seen that leverage among hedge funds, which is a separate data point, has been rising, and some people have used that to kind of say, starting maybe a month and a half ago, to start putting out big short calls on the market saying hedge funds are too levered up. We need to start shorting the S&P. And one of the problems with that issue is if you don't compare it with the exposure index, then you end up not realizing what's really happening. What I think is really happening there is they're taking much safer instruments like government bonds, for instance, and they're using debt or margin to lever up a safe instrument to try to make it act like a stock. So they want to keep up with their benchmarks, but they're afraid to get involved in equities to some extent. And maybe even they want to keep some of the shorts in place. So they're ending up levering up in safer markets and probably a range of instruments to try and synthetically create a portfolio where they won't lose too much ground while the market is doing this bear market bounce, which may turn into the next leg of a bull market as they start to get out of these positions and get back into a more normalized level of exposure, which is another one of these potential blow-off catalysts.
All right. And then just going to throw two things at you, Brett, and then we're going to circle back around and discuss the rubber duck metaphor that you have and how that's playing into markets right now as we try to tie all this together. But you were talking about some of the market references and sentiment data that people have been throwing out. One of the concepts that was thrown out was, of course, the short VIX position, as that's grown to 169,000 contracts as of April 16th. Of course, the short VIX structure breakdown was a pretty big function of, was it 2017 when we started seeing that play into the markets, right?
Yes.
So how are you watching the VIX, given some of the concerns around there? Because obviously, if people start seeing a pop-up in the VIX, then that's going to lead to a little bit of concern in the market. So how are you reading that for the VIX and a potential short squeeze in there, given some of the positioning, and using that as a sentiment read?
So I think we've got a very different situation than we had in early 2018, let's say, when we really played this idea of there being this extraordinary blow-up in the short VIX position, which I called a bubble at the time. I think that was tied in with the VIX term structure in an important way. As you look at the futures market for the VIX, each contract is pricing independently, and when you start to get an assumption of contango of each contract trading at a higher price than the contract before it, then you start to get some of these ETFs, and that's really what blew up, the ETNs, that were basically playing this idea. You could participate in that trade by getting along something like SVXY, which has completely collapsed in the wake of this, because it would benefit from the contango roll in moving from one contract to the next. You're basically shorting something like a spot VIX position that is subtracted from the roll gains that happen, which are negative roll gains because it's a contango roll. So you end up with this kind of mathematical quantitative strategy that people piled into because they didn't believe that backwardation in the VIX futures was likely at any time, particularly coming out of the tax reform bill. And backwardation would mean that the next couple of weeks are more uncertain than 3 months from now. And you generally don't get that in the VIX futures. You generally get a situation where 3 months from now is kind of sort of philosophically, by necessity, more uncertain than next week. We understand more about what next week is going to be like than 3 months from now. It's just a very simple idea, commonsensically. And when you start to get some kind of a market crash or unexpected volatility coming out of nowhere, you tend to get backwardation, and backwardation is kind of the death knell of some of these ETNs. And we had such a massive position build up, huge, enormous. The assets under management for something like SVXY and some of these, XIV was another one. It was just insane. So it was a huge bubble of people who had no idea what they were doing, no idea what they were getting involved in, and obviously didn't realize that if the VIX were to go up 100% in a day, an inverse VIX ETF would go to zero. That's it. You're done. Or some of them, the 2X would, VIX goes up 50% in a day, it's gone. So they had this existential risk built into them and massive assets under management. And when we finally had a VIX spike, as we got into early February, we finally got backwardation in the VIX futures term structure. they were destroyed completely, and there was, just enormous positions in them. So we don't have a situation like that right now at all. In fact, this more matches up with something that I think is a recurrent pattern in markets, where you have a dramatic event and then you get something that looks a little bit like it, maybe 6 months or 12 months or 18 months later, and you get a kind of PTSD response where people start to more quickly assume, oh, this is going to happen again. And normally that leads to the exact force that prevents some kind of dramatic effect happening again, because people are on edge, and by definition they're not complacent about it because they've already seen the smoking crater and the mushroom cloud of those sorts of assumptions. So I think that probably we're a little bit into that situation right now with VIX short futures positioning. And the other possibility is that people are using a diversified hedge. We've just talked about the fact that there are too many hedge funds that aren't exposed enough to the upside in markets. There are too many institutional money managers who maybe are trailing their benchmark by a significant enough margin that they need to come up with ways to protect themselves against a blow-off. Because what if we get a blow-off in the S&P? I mean, a big jump higher, a parabolic acceleration to the upside. You're out of a career for some of these guys. So they need to hedge against that possibility. And one way would be maybe long S&P futures, but another way would be maybe short VIX futures. It doesn't mean that they're overly exuberant. They may be using the VIX futures as a quick way to play catch-up if we start to see a blow-off in the market to the upside.
Okay, and then finally, just real quickly, the USD yen mix. Obviously, everybody's always watching the yen as a safe haven play there. The carry trade, which isn't as prevalent as it was, but still remains on radars. There's a lot of talk about the move out of short positions in the US dollar, and people continuing to buy it as it bubbles up higher here. How are you reading the yen as a read-through for the markets right now?
I mean, the simplistic interpretation would be, as the yen moves lower versus the dollar, it's probably going to pair pretty well with how the VIX is playing, generally speaking, because we talked about over-leveraging in certain instruments. One of the ways leverage is derived is on borrowed yen, because borrowed yen has the least volatile interest rate, essentially. You're going to have the least likely...
It's been the same place for 2 decades, so...
it's the least likely situation to burn you in terms of cost of carry for leveraged exposure. So, and that's, if there's a price spike may go away. You don't need to return the trade, and, the interest rates, the rate on the borrowed capital to form the leverage, these are both really stable. The only thing that could suddenly, it really comes down to this. So you can borrow money from Japan and use it to lever up in other markets, and know that that's not going to burn you unless there's a sudden spike in real inflation in Japan. That's what it boils down to. And nobody believes there's any chance of that happening, for demographic reasons, for all sorts of reasons. So it's just kind of this well that people go back to keep increasing their margin, increasing their leverage, and it's known as the proliferated carry trade. And there is an assumption that the yen will be will mirror the VIX at a lot of times. You'll see it spike up just like it did in December when you start to see markets melt down and volatility melt up. So I would assume that people who are getting, really short the yen right now are pretty much the same people who are getting really short the VIX futures.
All right, so we've got a question and feedback. That's the $1 million question, and basically where we're going to tie this all up into, Brett. The person writes in, so how do you use the SPY liquidity premium and hedge fund exposure index to actually make trades? So here we go. This is what we're talking about. We're trying to, the first couple of episodes of the show is really going to be very educational, just so that you can start understanding when we note the SPY liquidity premium fell 14 points or whatever it might be, why that's important. And what we have here, Brett, from all the data that we were just talking about, we fall into your rubber duck theory, or your metaphor, I should say, and basically how we are looking at the markets right now. So I posted earlier for anybody that wants to follow along the rubber duck theory, but basically what we have is all these signs kind of pointing towards that. Brett, would you agree with that? Brett? Did we lose him again?
No, I'm here.
Oh, okay.
So I just got backwards on my mute button. So you want me to tie together the SPY liquidity premium, the hedge fund exposure index, and a rubber ducky floating in a bathtub?
Right, because all these sentiment theories are basically the reasoning behind that rubber ducky float in a bathtub theory, and this is basically the crux of what we're trying to get to and how we are viewing the markets and how we plan to make trades.
Sure. So if you want, the way that I deal with these things is I have two independent ideas. One is bias and one is setups. And they're really separate things. And I know that I want to do most of my activity when my setups historically have worked best in terms of context. So I tend to get less aggressive or more aggressive as we tend to move from one context to another. But as far as market bias, I have to be biased to the upside right now until I see some warning signs. That doesn't mean I won't take scalps to the short side. And you know, I am also invested in this market, so I have talked about this a number of times. In 2016, I took about half my capital, and I gave it to a fund of funds manager who has it in somebody who I knew would never sell and would stay very diversified, and so it's just been sitting there. And I would recommend this kind of strategy at a certain point. When you reach a certain point, it's a good way to say, hey, if the market goes into this bleed up, I'm not going to get this sense that I need to chase and I need to force things. I can be picky on both sides of the market. So that's one point. But another point, my bias is in a situation right now where I don't want to take a lot of short shots because I see things like SPY liquidity premium, things like where it matches up with the hedge fund exposure index. And as you said, that ties us back into the rubber ducky bathtub metaphor. Basic idea being we may see signs of complacency right now, but ultimately, at the end of the day, what we don't see is overexposure by big players who would represent the vulnerability of a major turn. At least we don't see it yet. At least I don't see it yet with the measures I follow. We don't see a reason to think that people are overly levered to this market in a complacent or exuberant manner that suggests an assumption that every day is going to guarantee them higher prices. Those are usually the types of things that we see when we get to a really vulnerable point that can lead to a significant top. We don't see a lot of that right now. So I would say the way that helps you place trades is it keeps you in the mentality of biasing yourself to the upside, but that doesn't necessarily mean that you have a setup at any given moment, because you also want to be able to say, here's a falsifiable way of looking at the market. If it goes down to this amount, I'm not going to stay in this trade. So I'll be in this trade until or unless it does that, and this is the type of setup that I see a breakout in. There was one setup this morning that I almost took in the NASDAQ futures, which was very similar to a setup I took last week that didn't work, where it was the initial 10 or 15 point kickdown right off the bell. When the market opens at a resistance level, you tend to see oftentimes a number of orders that have lined up pre-market that come in and immediately hit individual stocks, and you get this shock down that lasts 3 or 4 minutes. You can get long, and it moves back up and at least retests the highs and sometimes breaks out above it. I'm obviously kicking myself for not taking that this morning, but the bias to the upside would put me in a position of looking for that kind of setup rather than coming in and looking for opportunities to fade the market every day, which I think that a lot of traders have been doing. So certain data points will signal setups, but most of these data points are about biasing. The setups are separate. The setups are risk-reward relationships and patterns.
Understanding where the flow is going, basically.
To keep you away from situations. A lot of times a market that is grinding higher like this can bleed traders dry because they just keep looking for that top and they just keep getting short over and over and over again and getting beaten out of it. And understanding where you are in the sentiment cycle, understanding where you are on that roadmap, that spectrum from one extreme to the other, it's really about avoiding those situations. The way that they make you money is by keeping you away from taking a million little slices as you keep on trying to short something that really isn't ripe.
Right, and basically trying to get you to swim with the current is the theme.
To bias yourself in the right direction so that you know which side of setups you're looking for. It doesn't necessarily mean you're going to constantly find setups, and when volatility gets low in a kind of extended uptrend like this, I think that, this is an investor's market in a lot of ways, and it will turn back into a trader's market at a moment's notice when it happens. And for bottom-up guys, this is a trader's market if you're looking at individual breakouts in individual stocks. But for top-down guys like myself, I think that there's not a tremendous amount of intraday trading opportunity. I've said that a number of times over the last 3 to 4 weeks or so. The action's picked up a little bit, and I think it will continue to pick up. But this is the kind of situation where you want to avoid taking the hits. If you're trading top down, this is something that's kind of grinding higher until it's ready to fall off the vine.
Right. All right, Brett. Well, I think with that, we're going to close out this edition of the show, but we will be back next Monday. And we're planning on running Mondays at 2:30 p.m. on a regular basis.
Let me cut you up one second.
Sure.
Let me go 2 minutes into the rubber ducky bathtub metaphor.
Okay. Yes. Sure.
Kind of skipped past that. So
yeah, sorry.
The idea here is it ties in very well with what we were just talking about, which is a lot of people I think have an almost impossible to avoid kind of heuristical shift where they feel like the market is almost like a physical system, and it is a push-pull process of money coming in versus money coming out. And the real reason why this ties into our conversation and it's important is if you look at the SPX chart right now, it looks just like a missile straight to the upside. And I think that for a lot of people, if you don't think about it deeply, you end up feeling like that means there must be just massive amounts of money coming in. But that's this rubber ducky bathtub metaphor that I think we have an all too easy time slipping into when we think about the market. And that is, you've got a rubber ducky, it's floating on the surface of the water in a bathtub. When you turn the faucet on and pull the drain, you basically put the drain plug in, you're going to see the water rise, you're going to see the ducky rise. The ducky represents the price. When you turn the faucet off and pull the drain plug, you're going to see the water level fall. You're going to see the ducky fall. And I think people just think of the market that way, money coming in versus money going out, pushing the price up and down. But the reality is every transaction is an agreement between a buyer and a seller. And it can happen at any price. The next transaction on the S&P could be at 3,500. It's not going to be, but in theory it could be if we have a group of sellers and a group of buyers, and that's where they end up finding agreement. You know, maybe there's some news that comes out that revalues the market up to there. The point is, you're not going to get sellers below there. So it would take just $1 to push the market up from here to 3,500. It doesn't have to be a push-pull of this kind of physical force arrangement. It's an auction. It's a running auction. There's got to be an agreement between a buyer and a seller. So you can have a situation where the market goes up a tremendous amount without very many people getting involved, which means there's not a lot of vulnerability even though there's a large run. That's why you need to look at data points like hedging data, sentiment data, surveys, VIX term structure, SPY liquidity premium, all of these issues to figure out how people are really feeling about the market, because otherwise you're just going to feel like, well, it's gone up too far, I need to start shorting, and you may be midway through the trend. And to understand where you are through phase of trend, it's important to take into consideration some of these data points. So with that.
Okay, all great points, Brett. And again, these are theories that we'll be continuing to talk about on the site and really playing out over the next couple of weeks within this segment itself too. So, Brett, you got anything else to add at this point?
No, that'll do it.
All right. So again, if anybody has any questions, let us know. We'll start also doing a little bit of a companion set on some of the commentary and some of the reports that we're going to be going with, just so you have a reference material and understanding of exactly where we're coming from, why we're pointing out different pieces. So that should be helpful. But again, these first couple ones, like I said, going to be a little bit more on the educational side. We'll certainly be providing our bias on directions every week and providing plays when they seem fit. But for now, we just want to get you used to the terminology and understanding what the process is for this. And we're actually going to be building off a couple of pieces from it, looking more at some of the flow data that we're seeing into different industrials. So hopefully everybody is finding this pretty useful. Feel free to write in with any questions that you have or any comments on the segment and anything you'd like to see added. But hey, Brett, as always, thank you very much for your insight into this. It's I know it's helpful for me, so I'm pretty sure all the subs out there are definitely getting a good use out of it too.
You got it. Yeah, I hope so.
All right, I'll talk to you soon.
Okay, thanks, Gavin.
Okay, bye.